Bank of America and Citigroup shares are both down quite a bit today. And while both banks beat per share earnings estimates, second quarter revenue was less than Wall Street expected. Joining us now from Chicago is Marshall Front, chairman of Front Barnett Associates. With 40 years of investment management experience, Mr. Front helps oversee $500 million in assets. He currently holds more than 700,000 shares of Citi and maintains large holdings of J.P. Morgan and Bank of America as well. Marshall, welcome back to Bloomberg News. Thank you so much for coming on today. A very busy news day. First off, you heard those earnings, the bank reports out today. Let's get your initial reaction to what was going on.
Well, it was a tale of two different themes. Certainly, credit was a very big positive and drove the earnings. But the digging deeper into it, it was really an issue of revenues and the lack thereof. The revenue growth that many analysts had expected didn't materialize, and it reflects really, I think, the deleveraging that's going on in our society, the lack of confidence, lack of loan demand across the board. So right. These things should not come as a surprise to investors, to the extent that banks are going to improve their situation, it's going to come because the macro environment improves.
But Marshall, I'm sorry.
Little they can do otherwise.
Right, but
yeah.
part of the silver lining here, I think you're trying to dig into that, is that credit did improve beyond a lot of people's expectations, did it not?
Yes, it did indeed. In fact, home equity loans, mortgage experience was really better than we had expected at a number of the banks. So on the credit side, it looks terrific. But on the other side, really, banks are going to have to be able to generate revenue growth. And it doesn't look like, and the market's telling you this, doesn't look like it's going to happen in the immediate future.
Right, because economists are forecasting a soft second half here in the U.S. So credit conditions, can they continue on this trend of improvement, or are they going to face additional hurdles because of the broader economic challenges?
Well, that's a question. If we go into a double dip, which we are not forecasting, I think we're going to have to look at the credit situation again. But for the moment, I think we're probably peaking at the rate of improvement in the credit situation. We'll continue to see good gains there, but the momentum there may be less in the next couple of quarters.
Are there any offsetting factors where we could see these banks get a boost in revenue, or now that you have to factor in reg reform, which also making news this week passing through the Senate, will that be another hurdle? Are we just going to have to enter or have lowered expectations for this industry? Is this a whole new era?
Well, I think the price-earnings multiples in the stock prices, the prices relative to book value have already discounted what you've just said. With respect to the model changes that banks are going to have to go through, clearly there are going to be big hits with respect to some of these charges that banks have been making, and they're not going to be able to make. But as they move along, they're going to apply charges to many services that they've been providing free, and that's going to help offset some of the increased costs as a result of this re-regulation.
Marshall, we had Brian Moynihan of Bank of America on today. He was interviewed by our Eric Schatzker. He told us it's going to take a few more quarters for you to see sustained activity. He continued, we're sort of in a state of moving through the muck, and yet we're moving in the right direction. Is that an accurate forecast on his part?
I think he's right. We're awfully impatient. We're in a world of instant gratification, and you're not going to get it here. People who are interested in investing in banks really have to look at normalized earnings a couple of years down the road. And if you do, you'll see that these stocks are selling at 5-6 times earnings. They're selling at discounts from book value. And so you could see substantial appreciation. But in the interim, this is not a straight road up. And the road is going to be lumpy because we're going to go through this macro environment where we're going to see some good economic data. We're going to see some punk economic data. That's the nature of an economic recovery.
So you have a significant position in both Bank of America and Citigroup. Do the earnings, does the passage of reg reform encourage you to make any major shifts?
No, not really. Our focus is beyond the quarter, actually beyond this year. So we'd be buyers of these stocks on weakness, and we're getting that weakness. So there's an opportunity to add some more to those holdings.
Speaking of stock performance, Goldman Sachs shares shooting up on the news of the SEC settlement yesterday. What do you think of that reaction, and what's your opinion of Goldman Sachs shares from here on out?
It was interesting. We had set about $125 buy point on the stock. We do not own it now. And the stock came very close to providing us with that buying opportunity. That was set relative to what we thought their book value was. The settlement came sooner than we had thought, and the settlement was more favorable, as I see it, monetarily for Goldman than our expectations were. So I think it was a win for Goldman. It clearly gets a major issue behind them.
Right.
Are there other lawsuits? Are there other Wells notices coming? God only knows. Other institutions are likely to face the same kind of landscape, but
right.
I think this is a major point for them.
Marshall, could I ask you about financial regulatory reform? You just touched on it a moment ago. Does this regulatory reform legislation have any teeth? A lot of people complain that it's just regulatory overreach, and specifically, it doesn't really tackle the issue of Fannie Mae and Freddie Mac.
Well, you can get into the specifics, but I'd make one general statement that I think viewers should really keep in mind. No one can foresee what set of circumstances will evolve over the next decade or the next generation that will bring on the kind of economic collapse that is likely to take place. And so protecting us from the evils of what we've just been through may not be a solution to our future problem.
Right.
I think that's a generalization. Sarbanes-Oxley taught us that overregulation has unintended negative consequences for the society, and I suspect we'll find out over the next 5 to 10 years what the unintended consequences of this legislation are.
Now, Marshall, you just told us you believe that the investors had discounted what is ahead for the financials industry. Well, of course, the financials is the greatest sector group making up the S&P 500. We're at session lows here. The Dow is off 214 points. The broad market average is down 25 points. The financials industry leading the declines. Is it likely that the industry as a whole is putting in more declines and discounting what's ahead even further?
Well, we had a run-up. First of all, put this in a bit of perspective. We had quite a run-up late last year, and again in the market move up recently in these financial stocks in anticipation
right.
of good earnings.
Yeah.
So we're getting a bit of a retracement. But let's not focus solely on the financials today.
Yeah.
Let's focus also on the consumer data
and Marshall,
that came out.
And Marshall, I'm so sorry, but we're running up against a commercial break. Marshall Front joining us. Marshall, thanks. We'll be right back.